Hello, and thank you for joining us for this very exciting webinar this afternoon. My name is Anna Perdrio. I am the founder of Speaking Excellence, and I am your host for this very exciting webinar with ATB Partners. And in a moment, I will introduce to you some of our speakers today. But first, I'd love to, first of all, welcome you as our participants in the webinar, and I'd love to just cover a little bit of housekeeping. Of course, first of all, if you haven't been on one of these sessions before, we love interaction, so please feel free to jump in at any time with a question or a comment or some encouragement along the way, and you can do that by using the Q&A button at the bottom of the screen on the menu bar. And please just type in your questions there, and I will make sure that those are answered for you along the way. So you can do that at any time. And as I said, we love the interaction because these sessions are for you, and we want to make sure that you get the best value out of them today, of course. All right, so this is a very exciting subject today. It's all about tax planning and tax saving strategies, which, well, everybody is interested. So I think there's not one person who doesn't say, yes, I need to know the latest on that. So that's why today is a great topic, and we're looking forward to receiving your questions and interactions and hearing from our experts today. Of course, we have Jim Vass and Paul Rattray, and let me tell you a little bit about them. You probably already know, but you love to hear it again. Okay, so first of all, we have Jim Vass, who is one of the founding partners of ATB Partners. He's an accountant, financial planner, tax advisor, and business mentor. He's worked with small, medium, and micro-sized businesses over many years, in fact, decades, and he's helped a multitude of businesses to confidently navigate the uncertainty of the global financial crisis in 07-08, and of course now during these pandemic times. And Jim understands very unique issues faced by SMEs and sole traders at this time. So welcome, Jim.
Thank you, Anna. Thank you for the lovely introduction, and welcome to everybody that's joined us today.
Yeah, fantastic. And we also have Paul Rattray, who's a highly experienced chartered accountant. And of course, together, Paul, Jim, and Michael are the directors of the Parramatta-based accounting firm ATB Partners, which was created or started over 25 years ago now. And this successful firm is well known and highly sought after for its tax consultants, financial advisors, and business mentors. And they've served clients in a range of industries from retail, wholesale, manufacturing, professional services, franchising, and construction. So what a diverse client range. So welcome to you, Paul.
Thanks, Anna. Again, thanks for the introduction, and thank you everyone who joined us today.
Yeah, great. All right, we're going to get into the content now. It's all about the tax planning, and let's see what we have here. Of course, there's the team from ATB. As you can see, lots of happy, smiling faces. And you've probably met them along the way, or maybe you will in the future. Now, here's our topic. Look, tax time doesn't have to be terrifying, and we're going to learn how we can save money by being smart, which who doesn't want to know about that? So let's jump in. We're going to start with the business tax strategies. And I think we're going to head to Jim first of all. Take it away.
Oh, well, what we're going to be doing today, because tax is such a fluent topic, we're probably going to be doing today's webinar as more around a discussion where I'm sure that I'm going to be interjecting with what Paul says. Paul's going to interject with me, and it might make it a bit more interesting because tax in itself, when you look at it just purely as it is, it gets quite dry, and we don't want people falling asleep whilst they're operating their computers. So one of the things I suppose we wanted to start off with is holding off invoicing and banking and delaying it just by 1 day. So this really comes down to the method of your accounting reporting and how you report your tax. So if you're on an accruals method, which means that you report your income tax based on the invoices that you've raised as at the 30th of June and the accounts payable that you've put into your accounting system as at the 30th of June, if you're on an accruals basis or an invoice basis, then delaying invoicing would certainly keep your income lower. Okay. Now, if you're on a cash basis, then that would mean that you're reporting your income and your tax based on how you receive money and how you spend money. So obviously, in the days when people would pay you by check, not banking the check on the 30th of June and banking it on the 1st of July would have made a difference. Nowadays, where most of the payments are really via electronic means, that type of strategy makes it's a bit harder to try to control, because you can't really control when people are going to transfer money into your account, which is also going to be the basis of some of the strategies that we're going to be providing you as well later on, because I'm pretty sure that if you said to somebody, I want to prepay you some expenses, but you're going to have to pay tax on it now earlier, they're not going to be happy about that either. So that's my spiel on that one, on the invoicing and the delaying invoicing.
Of course, Jim, the other side of that is other people like to get paid. So if someone says, I'm going to pay you 12 months in advance, even though you've got to pay the tax, it still actually is good to get paid the money in your pocket, isn't it?
Yeah.
Because we all know that you need cash flow to live on. So as Jim said, you pay out, you don't bank money on time, like you do it a day later, and you prepay expenses. Now, we've got a list here of the general business expenses that most people have in different parts of their business. And the rules are, say, if we talk about June 2021, you can actually prepay for up to 13 months. So you can pay June and another year and claim it as a tax deduction. So it means you've got to actually have the money, but it is a really good way of bringing the expenses forward so that you don't pay tax on that money that you pay out. So, you know, if you've got interest expenses of $1,000 a month, then you can pay that $12,000, and that reduces your income by $12,000.
Yeah. Keep in mind though, on that interest though, that works quite easily when you've got an interest-only loan. But if you've got, say, a principal and interest loan, you'd need to probably organise that a bit earlier with your bank to ask them to provide you with what the interest is going to be, so you can prepay the interest on it. Because if you simply made, if it was a P&I, principal and interest loan, let's say hypothetically $2,000 a month, and you paid $24,000 up front, the entire $24,000 wouldn't be tax deductible to you, because it'd be an element of a principal reduction as well. So what it's actually the $24,000 up front would actually just be seen as a principal reduction. So what you need to do is you need to actually speak with your bank to tell them what you're going to be doing in order for them to be able to acknowledge that what you're paying is the interest on that loan. Okay, so be careful, because that could be a trap that you fall into. On interest-only loans, that's fine, but on a principal and interest-only loan, you're going to actually have to get something in writing from your bank that they've agreed that this is what the interest charges are going to be for the next 12 months, and you pay that.
And also too, things like car finance or even some bank loans, if you pay early, there might be some penalties on that. So you've got to check for that as well to make sure you're not going to incur fines for paying off early. I certainly know a lot of the car leases have that in place. So if you actually pay off early, there's fairly severe penalties for doing so.
Now,
you would also need to do that, you know, writing a letter to them.
Yeah, well, you'd have to have a look at your agreement, because typically what happens is if that 12-month prepayment might be that you're still going to pay the same amount of interest regardless, so you're not going to get out of anything. So you'd want to, anything that involves principal and interest, a reduction of your debt, you'd probably want to speak with the financier first. Okay, there's easier ways of getting a deduction rather than trying to prepay the interest on a principal and interest loan. But there's a lot of loans that are structured as interest only for business, and then it's quite straightforward. So you just sort of say, all right, well, look, I want to be making a principal, an interest reduction for the 12 months, and you just pay it up front. But you can see though, if you don't actually quantify that with the financier, they're going to take it as, well, you've just paid $24,000, so you've just reduced your overall debt by $24,000.
Yeah.
Okay.
They're going to assume.
Yes. Now, interest as well, insurance as well is one of those things that anything that Paul and I are going to be recommending today does not involve you spending any money that you wouldn't ordinarily spend. Okay. So if you know that you've got insurance premiums that are going to be falling due in October or November, and that's a $10,000 premium, which you're going to have to pay, there's nothing wrong with actually just bringing that forward. Pay it prior to the 30th of June. All it means is you're going to reduce your income in the current year, reduce your tax liability for the current year. You still would have been paying that premium come September, October when it was due. So it's not as if we're sort of saying you've just created an expense that you didn't have to incur. Okay, and that's really important to keep front and foremost in your mind. Is it's not about spending money where you didn't need to spend it, because there's no benefit in doing that.
Yeah, we get asked that one a lot. Should I buy a new car? And the first thing we always say back is, do you need a new car? Because there's no use spending money just to save 30% in tax, or at the moment we're talking about business. So the company tax rate,
27.5, yeah.
Yeah, 27.5%. Now it's going to go down to 26%. So why would you spend $100 to get $26 back? Doesn't make sense. So
unless you needed it, of course.
Yeah. Okay, well, the next one we've got there is rent. And again, the caveat with that is that you actually do need to check with your landlord that you can actually pay that rent in advance.
Yeah. Oh, well, you see, I'd take the different approach of I wouldn't check, because that's where you got their bank account. You just drop 12 months worth of rent in it. They've received it.
Fair enough. Again, it depends on your lease, of course. Yeah. But yeah, look, that's a different strategy. Look, that amount of money going in could cause issues for them, but it's about you paying expenses and getting a tax deduction.
Yeah, like was stated earlier, that's certainly one situation where the landlord's going to be saying. Now, the landlord as well, dependent upon how they're accounting for stuff as well. I mean, their taxes, they might, if they're creative, they might be able to get out of it, out of the income. But at the end of the day, our concern is tax planning strategies for you guys. It's not about the recipient. The recipient, they've got to have their own strategies on how they're going to address prepayments of rent and prepayments of insurances and everything else. So that's not our issue. Our issue is to basically minimise your own taxes. And certainly with most people that do pay rent, they either pay it to the real estate agent or they pay it directly to the landlord's bank account. And there's nothing stopping you from saying, all right, well, I'm going to pay even 3 months rent in advance or 4 months rent in advance prior to the 30th of June.
And one thing we do need to stress with this too, you've got to be careful, because as we know in business, cash flow is very important, and there's no use spending all this money getting a tax deduction if you're going to run out of money in a month or two. So you do need to talk to the accountant, which hopefully is us, about budgeting and about cash flow and all those other very important issues as well. Tax is not everything. Those things are very important too.
Very true. Now, superannuation, that's an interesting one, because dependent upon what your payroll or what your pay cycle is, typically what will always happen is you may have a pay period that ends on say the 27th or the 28th of June, and you may still be paying your superannuation on a monthly basis. So May superannuation you've already paid sometime in June, but the June superannuation, you might be saying, well, that would normally fall for payment in July. But if you actually pay that superannuation on that pay period or for that month up to all the wages that you've paid, so if you've got something ending, a pay run ending on the 27th of June, if you're going to wait to pay that whole month's superannuation after that pay run, the likelihood is it's not going to be received by the superannuation fund. But if you're going to say, well, what were the 3 pay runs beforehand, all the previous pay runs in the month, excluding the 27th of June, and I'll pay that superannuation, and I'll make sure that that's paid by about the 22nd, 23rd of June, and you make sure that that superannuation is received by the superannuation fund, then at least you're going to get the tax deduction for that superannuation payable in June. So therefore, the super that you're going to be paying in July is only going to be for 1 pay period. So effectively, you've taken up most of the deduction in superannuation in the current period, in the current financial year.
Yeah, Jim, it is important, isn't it? Because if the super fund hasn't received the money, then it doesn't count as a tax deduction for you.
Correct. Correct.
I think
That's, yeah.
last year, I think the 20th was the date that they gave us. They wouldn't guarantee any super payments after that date to be
And
taken.
it depends upon when the 30th of June falls. If the 30th of June falls on a weekend, then your payments have got to be a bit earlier. If the 30th of June falls during the weekday, then you've got a bit more leeway. But certainly, if you give yourself at least 7 days, 7 business days to make sure, that's certainly a strategy that can actually work and can save you money. And this one's our favourite, isn't it, Paul?
It is paying other expenses such as accounting fees. Look, that is very important because obviously, again, if your bill's going to fall in July or August, then paying it in June, you get the tax deduction up front for it. And look, it increases our income, but personally, I don't care if people pay on time. That's good.
Yeah.
But
the reality is as well, and this is also for our service-based business, or if you've got a service-based business, if you get prepaid, okay, now in a lease, like when we're talking about prepaying your rent in a lease, you've actually got a legal obligation that you've got to pay X amount of rent for the use of business premises, right? And even if you said, look, I'm going to leave, I'm going to vacate your premises, you've actually got a legal obligation where you've still got to pay that rent. Okay, so prepaying the rent's a different matter. When you prepay professional services, and this is also if some listeners out there are in professional services and they get prepaid for their services, is you haven't delivered those services as yet. And because you haven't delivered those services as yet, it's not necessarily income to the recipient. So if you were to prepay us for a service which we have not delivered yet, have not performed yet, effectively that's a prepayment. That's not income in our own names. Okay, and that would be the same for any listeners as well. If you've actually received the prepayment, okay, and it's really dependent upon a service that you're going to provide in the future, which if you don't provide, you're going to be obligated to refund that money back to the person that paid you, then you can actually get around the tax issues individually.
That is important. And look, with this one, it's not just accounting fees. Like we've listed 4 of the more common ones that most businesses have, but there could be other things like you might have a storage facility that you pay for annually to store things. Well, again, you can prepay that. Now you can prepay, like for instance, if you've got some software that you know you're going to install early in the next financial year, you can prepay that as well. Like there's so many different things that every individual business has different things that they have to pay, different subscriptions, all that sort of thing. So anything that, as Jim said, it's a service that you're going to use that you're going to have to pay anyway. It's good to prepay those as much as you can.
But you think about internet, you might have a standard usage of internet, $400 a month. If you prepay that, you got to use it. It's not as if it's not going to get used. Yeah. If you pay your telephone, all it's going to mean is you're going to be getting invoices going forward that are going to be in credit. So you just don't need to pay it. And that's going to be applied to mobile phone bills. It's going to apply to a whole heap of things like that.
Yeah. So, all right.
Right. And just on that point that Jim raised in terms of the day of the week, that the 30th of June, this year it's a Wednesday.
Okay. So
middle of the week.
Yeah. So you'd probably be sort of saying Monday the previous week, you'd be safe.
Great. Okay, so let's dive into more business strategies here to save money.
Okay, so a lot of businesses need assets. They need tools, pieces of equipment. They need consumables. Now, the consumables and stuff like that. Again, if you go through a fair bit of paper and printing and stuff like that, or stationery or whatever it might be, it's minimal. But at the end of the day, if you're going to be saying, all right, well, look, I know that we're going to be needing a whole heap of supplies for the kitchen. We're going to need photocopying paper. We're going to need to stock up on other pens and papers and stuff like that. You might as well get it prior to the 30th of June. That's when all the sales are on as well. And also get the tax deduction for it in the current year. There's nothing that the tax office will say, well, you've got too much of that and you're not running your business efficiently. If you spent the money on that on the consumables, you get the tax deduction for it.
Mm-hmm.
And again, we talk about that along with cash flow and storage and things like that. But anything that's practical to buy, you should buy it. It just makes sense.
Okay.
Now, to build on that, as you know, in Australia the last couple of years has been the instant asset write-off, which the government has put in to try and get people to spend more money on business assets, also to get money back in the economy, get things moving. So I think, Jim, that got extended in the budget again this year to June 30 next year.
Correct, it has.
Yeah. So it means any individual asset can be bought up to 150,000 and written off. Now, that's pretty good because a lot of things might normally get written off over 10 years with depreciation. So again, we talked about tools before. An important one in there that most people use is business vehicles. Now, it says 150,000, but for various other tax rules, around about $60,000, you can't claim the vehicle anymore.
So you mean I can't go buy a Ferrari or a Porsche for 150,000 and claim it as a tax deduction pool? Is that what you're saying?
You can claim some of it, Jim.
Right,
But
okay.
yeah, up to, there's a luxury car tax limit, and I don't know what the actual thing is, but it's around 60,000.
$60,000 approximately.
Yeah, 60.
So, yeah. Well, one of the important things to keep in mind with this is that it can be an asset of up to 150,000. Now, there's a lot of businesses out there that run fleets of trucks, earth-moving equipment, and the rest of it. So they're pretty expensive pieces of equipment. Now, it's not the total of, like if you bought two trucks at $75,000, two trucks at $80,000 each, it's because each truck is under the 150,000, you can claim the full 160,000 as a deduction. If you were going to buy 10 trucks at $80,000 a piece, if you had the cash flow to do it in your requirement, you're going to get a tax deduction for $800,000 in that year. Okay, so effectively what they're saying is you will get to expense everything in order to try to minimize what tax you've got, any tax liability. And we've got clients that have gone down this route of building fairly major pieces of capital and equipment that they needed in order to get their businesses set up for going forward, which ordinarily in the past when we've done this, it's been depreciated. There's been a couple of $100,000 worth of expenses, which is coming straight off the bottom line for the current year's income tax.
And with major machinery, that 150 covers the transport and the installation. So the machinery might cost 120. There's another 20,000 of installment costs. Well, you can write off the whole 140 in one hit. If you buy two bits of machinery for 140, you can write off both. So it actually is pretty generous. We've had clients, they've had multiple hundreds of thousands of dollars that they've actually been able to expense straight away, which means in that year, there's, even though they've made some good profits, the taxable income is actually quite low.
So it's 150,000 per asset.
Correct.
Unless
up to 150.
Unless it's totally set. Like if you buy something where there's three components of it and that they can't work individually, then obviously those three components together have to come under 150. If you buy the assets and they're worth 152,000, you can't write any of it off. If it's not under 150, you can't write portions of it off. So that's why a lot of things around that price have been knocked under there just to get people to actually buy them.
Right. Yeah.
Yeah.
Now, bad debts. A lot of people don't actually think about bad debts as they're always, I suppose the mentality is that if I write this debt off, it means I'm forgetting about it. I'm not really going to receive this money. And that's a psychological thing. But if you're a business that reports, again, on an accruals basis, so you've raised an invoice to somebody for services or products supplied and they haven't paid you, and it looks like you're never going to get paid because they don't return your phone calls, they're just being evasive, and you sort of think, look, it's just in the too hard basket. This is an opportunity to actually go through what's outstanding and clean up the books for what is really old, where you're going to say, look, I don't expect that I'm going to be receiving this. I'm sick and tired of trying to chase it. And the likelihood is I'm never going to see this money again. It's a good opportunity to go through, clean up who owes you money and write off what you deem that's not going to be recoverable in order to at least create an expense in your accounts to at least get the tax advantage for the current year.
And of course, it goes without saying, if you do get some of that money back at a later date, you just declare it as income and everything's okay. So.
But typically there's those invoices, one would hope not too many businesses have got them, but it might be 2 years old where people don't return your phone calls and they're, $50 or $100, and you just sort of think, well, the reality is it's not worth anybody's time pursuing this. You might as well just get rid of it.
Yeah.
Now,
As Jim was saying, these are bad debts and you don't want the business to have them. So just a little bit of plug for a lot of us businesses with new outlooks. You should get your clients to prepay or at least be on progress payments with these things as well, because that would save a lot of heartache later. It's easier to collect the money before or while you're doing the service rather than afterwards. I'm sure you'd agree with that one, Jim.
100%.
Yeah.
It's the exposure, and particularly this isn't a tax planning conversation, but it's simply a matter of trying to minimize your exposure. Yep. So if you don't expose yourself too greatly to any particular customer of yours, that means that if anything happens to them, you've just minimized what could possibly happen, the financial ramifications to your own business. So looking around, a lot of us own business premises, and you sort of think, well, bringing forward planned repairs. Now, you might be looking around sort of saying, oh yeah, the office probably could do with a touch-up paint job, or we could get the carpet steam cleaned. We probably should be doing something like that, but it's always been put off because it's an inconvenience to the rest of it. That's what we're talking about, bring forward those planned repairs. So if there's something that you're sort of saying, look, we're going to have to do it anyway, at some point in time we're going to do it, or why not bite the bullet, get it done earlier, get it done this side of the financial year, paid for this side of the financial year, and that way you can use it as a tax deduction for the current year.
And obviously the last point we've got there is very similar. A lot of times around this time of year, most bonuses either get paid at the end of the financial year or the end of the calendar year. So if you are going to pay any bonuses to team members before June 30, make sure you actually pay them before June 30 rather than going to the next financial year. Because if you're even one day late, it takes a whole year for you to get that tax deduction. And that's a long time to wait for money that you've already paid out. So that one there is pretty important. Again, it doesn't always happen instantaneously, so you do actually have to plan that one a little bit in advance. You can't just wake up on the morning of June 30 and say, I'm going to do all these things. All the stuff we've talked about, you actually have to sit down and plan, make sure you can afford them, and see which ones will give you the best benefit.
Yeah, that's you do your list, you do your wish list and see what's going to give you the best bang for your dollar, what's going to be within your budget. Because again, what Paul said earlier, it's very easy to say, hey, spend the money here and spend the money there, but you've actually got to have the cash flow in your business to be able to support that. So just because you prepaid 12 months worth of rent, you're still going to have wages to pay next month. So it's no good telling your employees, hey, look, I can't pay your wages because I prepaid our rent. So everything's got to be done with a sort of thought in mind of what you're going to need to keep your business operating.
Yeah, that wouldn't go down very well, would it?
No, not at all.
All right. Okay. So I think this is on the personal tax side now, is that?
Yeah, yes.
Ways to be smart with your tax.
Okay, let's start off with this one. The superannuation contribution, we're allowed to get a tax deduction up to $25,000. So this one here, but that $25,000 also includes the 9.5% you get from any employer that you've got. So now if you're on $100,000 a year, you'll get $9,500 tax. So superannuation paid, sorry, yeah. So then before you can put in another $15,500 to get yourself up to the 25,000 cap. So, and you do get a tax deduction on that. And if you're on an average wage, you'll get somewhere between 30 and 40% back on that. So putting that 10,000 in to get 3.5 or 4,000 back, it's actually a really effective way of saving tax and contributing to super, which is a good thing. See,
what a lot of people may not be aware of is probably about 2 years ago, the legislation changed where in the past you had, if you were largely employer supported, which means that you you were employed and you received a superannuation guarantee payment from your employer, if you made personal contributions towards your superannuation, you couldn't get a tax deduction for it. Okay, so the only avenue open to you would have been to make a salary sacrifice. Now, you think about the scenario that Paul just talked about, where if you kicked in $15,500, you'll get to your cap. Well, that's all well and good if in June and you earned $15,500 a month to be able to salary sacrifice the full amount to get you to the cap. Because if you don't earn that and you're not in that position, you will probably say, all right, I'm going to go into my savings to use that money to contribute it to superannuation. And again, you've got to make sure it's received by your superannuation fund prior to the 30th of June. But then you can actually claim that as a personal tax deduction, okay? And it'll be you're going to get a definite tax benefit back when you're lodging your tax return, because you'd be advising your accountant that I've made a personal contribution. You also need to advise a superannuation fund that you're intending on using that contribution that you've made as a tax deduction in your personal name. And then it's obviously going to have a definite tax benefit to you.
And that cap's going up to 27,500 this year, isn't it?
1st of July. 1st of July, we're 27.5.
Yeah. It's about time. It used to be actually at 30,000, and they thought people putting too much money into super, which sort of goes against what they're trying to do to make people self-funded. So
yeah,
various governments have done a couple of funny things in this area, but as Jim said, this is a really good one. The big disadvantage where you could only get money in salary sacrificing, if you work for a small company and you went to your boss who's only got 2 employees and said, I want a salary sacrifice, they're going to look at you and go, I can't do it, it's too hard. So it was really disadvantaging people who work for small business. So these advantages, which came in 3 or 4 years ago, are fantastic for everyone because it just puts everyone on a level playing field, which is good.
Yeah, the government's actually seemed to have come to its senses over the last few years because, again, like Paul said, years back you could contribute $30,000 to super on an annual basis, and for whatever reason they thought, no, well, we don't want people to self-fund themselves in superannuation. We'd prefer that we actually be using our taxes to fund retirees as well. And now somebody's seen the sense and saying, no, that's not really right. Maybe we should actually help people be a bit more self-sufficient. So no sarcasm there whatsoever, but
it's a phrase you don't hear often, the government coming to its senses.
Yeah. So what they've brought in a bring forward rule. So if you're in a position where Paul used that example before, you're on $100,000 and you contribute $9,500, or the SGC contributions or your employers contributed $9,500 per year for you, okay? You've got that $15,500 that you can contribute. Now, if that's been exactly the same from 2019, all right, you could go back to 2019, 2020, and for the current financial year as well, and contribute 3 lots of $15,500 towards your superannuation and actually get a tax deduction for about $36,500 as a personal tax deduction in the current year. Now, whilst a lot of people might look at that and sort of say, well, why would I want to do that? But you have a think about what other things may be happening in your tax returns as well. So if you've got capital gains, if you dispose of a property or whatever it is, these are some fairly good strategies to be able to try to control the tax liability that you may be incurring.
Mm.
And sometimes you're just getting closer to retirement. You've got some money, you might have got an inheritance, there might be all sorts of reasons why you've got it, and you just want to get that money into super because it's actually much more tax effective than investing in outside super. So as Jim said, there's a lot of reasons to do it, and now we're actually allowed to do it, which is really good. Okay, so the next one is prepayment of interest on investment loans or margin loans. Now, this one here, a lot of people actually do this one. If you've got an investment property where you know, again, as Jim mentioned earlier, a lot of investment properties are interest only. So if you know you're going to have to pay $20,000 in interest, you can prepay it and actually get the tax deduction personally this year. And if you're on one of the top marginal rates where you're paying tax at 40 or 45%, then obviously that's a fairly big tax deduction. And a lot of people will use it. If you're getting back nearly half of it, it's a good way of actually funding that payment. You just get
but again, you'd need to get it in writing from your bank, acknowledging that they're going to apply that prepayment against the interest component and not do a principal reduction.
Yeah.
Okay. So if you're planning on doing that, I strongly recommend that you actually start talking to your financier now, because banks it doesn't happen very quickly with banks. So you want to make sure that you start this conversation soon. If you're going to leave it for 5 days prior to the end of financial year, the likelihood is it's not going to happen.
And we look at negative gearing most of the time when people hear about negative gearing, which is when you've got expenses greater than the income, they think of property, but you can also negative gear on shares. And a margin loan is really the same thing as paying for a loan on an investment property. It's just using shares rather than property. So it's the same thing. It's just got a different name. And you can also prepay that interest as well. A lot of people might borrow, say, $100,000 and then buy shares. You know, again, that your loan's going to be a certain amount. The interest payable is going to be certain. As Jim said, you've got to do it with the financier, but you can do exactly as you do with property on shares. So you can prepay that interest and get the tax deduction. So it is pretty good. And it's again, it's a nice way of paying. Like that tax deduction can then help you do more investments, or it can help pay other bills. So. But you do have to be a little bit careful with some of these things, because if you've got a more complicated tax return, it might take you 6 months to get all the information together. So of course you can't actually get this money back until you lodge a return. So you do have to make sure that everything else is in place as well to make these work well.
Now, depreciation schedules or quantity surveyors reports for rental properties. Now, if you want to be able to claim either the capital allowances, basically the depreciation on fixtures and fittings of a property, or the building write-off, which is what it costs to build the building, which you can claim over a 40-year period, it's always recommended that you have properly engage a quantity surveyor to prepare this depreciation report for you, because you actually do need to have one to satisfy the tax office in the event of an audit. And these people here will be able to look into it and sort of say, right, well, we're estimating this building cost X amount to construct 10 years ago when it was built. And this is what you can claim, like, yeah, this is the depreciation that's being claimed, and this is what you can claim going forward on each year. Now, typically those reports are going to cost you about $500 to $600, which again, that expense is tax deductible. And also, so I would probably, if you're going to be doing that, if you're in a position where you've purchased a rental property which hasn't had a schedule prepared for it, a depreciation report prepared for it, if you were to engage somebody now and pay them now, you're going to get the tax deduction for engagement of their services, even if they provide you with a report post July or post 30 June, you're still going to have that report ready for you to be able to complete your 2021 tax return.
Jim, they've changed it a bit this recently, haven't they? It has to be a brand new property to claim now.
Yes, but you see, again, if you engage a quantity surveyor, okay, they understand the changes, and what the report they're going to provide you is with what you can actually claim.
Yeah.
So what we're doing is we're actually saying that we're relying upon a recognised expert in this field, which the tax office recognises to be an expert as well. So providing that you've appointed somebody, whether it's a brand new property, whether it's a property that's 10 years old, you're relying on the quantity surveyor who's approved by the tax office, that you can rely on those reports to actually be given a depreciation schedule that you can claim.
And is that just a one-off thing that you have to do, or are you saying you could do it every year?
No, you do it once, but it's going to tell you, like, say, for instance, depreciation on a property is over 40 years. So you've been provided a report that says, well, this is how much you can claim every year for the next X amount of years till that 40-year period is up.
Right.
Look, Anna, it's a little bit more complicated even than that, because the 40 years is on the structure of the building.
Right.
And this is where the quantity surveyor comes in. Carpet's done at one rate, curtains are done another rate. You name anything that's a fixture that's not permanently attached is done at a different rate. And that's why you've got to have a qualified person, so that every year there's two different classes of depreciation, and there'll be a figure from that report that you'll be able to give to the accountant to claim. So it's not simple, but those reports make it a lot easier, which is why people get them. Yep.
Right.
Okay, and the last one, again, prepayment of fees. Now, the two that a lot of people have personally are income protection insurance, which again is tax deductible because it's linked to your income. So you can prepay your premium for the upcoming year, and any accounting fees. But look, we just use that. Any professional fees that you know you you are going to have to pay, you can just prepay.
Mhm.
So there's other things too, like top of my head, if you normally donate to any charities, do that before the end of the financial year. So again, you can claim the tax deduction straight away. Any others you can think of, Jim?
No, but I'd like to actually go back to the income protection, because that income protection, it surprises me how many people actually don't have that. Okay, so typically when I'm having a conversation with a client and you sort of say, oh, so you've got a Mazda 3, right? It's worth what, $15,000. Tell me, have you got comprehensive insurance on that? Yes. Okay, but you've got a mortgage, you've got a family, but yet you've chosen not to insure your ability to earn money. So if somebody was to steal the Mazda 3, as much as an inconvenience as it may be, it's not going to have a terrible impact on the family. It's going to be not a good place to be, but you think about people where they have a mortgage, they've got they're the main breadwinner, their wife's at home, they've got a couple of kids, and they don't choose to ensure their own ability to earn income. If anything were to happen to them, that would have a devastating impact on their own family. So this is, again, it's not tax planning, it's pure logic that a lot of people, if you don't have that income protection, you probably should be making a point of having a chat with us so we can actually make sure that your family is properly protected, because it just doesn't make sense that you'd be insuring those things that are not important to you, that will not have a huge impact, and ignoring the things that are actually going to impact your family greatly.
I suppose, Jim, that's a good point, because most people's working life is about 40 to 45, 50 years. So you've got millions of dollars of earnings over that period of time. So
Correct.
that certainly is probably the most valuable asset you're going to have, isn't it?
Yeah, correct.
Yeah, interesting.
Correct.
Very interesting. Okay, now we're going to look at timing and how timing can save tax.
Jim?
Yeah, so thinking about when you receive bonuses, or when you're looking at, there's a lot of people that are sort of saying, well, look, well, I'm going to retire, I'm going to take a redundancy. Should I take it prior to June, 30 June, or should I take it post 30 June? Well, it's simply a matter of just trying to figure out then what is the best time for you. Now, obviously, if you've got a full year's worth of salary and then you're putting redundancy payments into it, or bonuses that you're going to be retiring off to suit your retirement, you're just going to be loading up 1 year, and the following year is going to be very low. So obviously, you're best off to try to defer those payments to the following year in order to try to keep your marginal tax rates a bit lower.
And yeah, obviously selling assets can be very similar. A lot of people try and time selling their home about the same time they retire, because they might be moving somewhere different or downsizing. Like, there's lots of reasons to do it. And capital gains tax is calculated and then just added to the top of your other salary. So if you're on 100,000 and your taxable capital gains 60, then you'll be paying tax on 160,000 for that year. Whereas if you could delay the sale a little bit into the next year where you're not earning income, then you'll only be paying tax on the 60,000 capital gain. And because,
so of course, you're talking about an investment property, not your principal place of residence.
of course, yes, sorry, Jim, yeah. And then, well, we used house as an asset, but it could be any particular asset. And you get a 20,000 tax-free threshold. So the tax on 60 when it's by itself is actually a lot less than the 60 added to another amount of income. So timing like this can be really, really important, because you can save yourself tens of thousands of dollars in tax. And at that time of your life, obviously that means a lot.
Now, what's important to know here is the timing of any capital gains. And a lot of people get this wrong. The timing is not when the property settles. That's for instance, say for instance, you signed a contract to sell your investment property on the 15th of June, okay? But you don't actually receive the money till the end of July, okay? That capital gain is not reported when you receive the money. That capital gain is actually reported on the date of the contract, which is the 15th of June. So simply delaying signing the contract to the 1st of July would mean that that capital gain is going to fall in the following year, which would mean that you effectively, if if you're lodging your taxes on our lodgement program, say for instance, as an individual, you'd probably have till the 15th of May the following year to pay any tax applicable to that. Okay, as opposed to, because you haven't timed it correctly and you've signed a contract in mid-June, you'd be effectively bringing that tax payable forward by a year. So it's quite an important one, particularly when you're looking at the fact that if you got that money and say it's $100,000 in tax for the gain, and you can put that $100,000 to set it off in an offset account off your personal home loan, well, that's going to be saving you a fair bit of interest during the course of the year as well. So there's costs associated with this. So anything you can do to delay payment of tax is certainly worthwhile. And it's got to be legal.
Right. If I can just jump in here, we do have some great questions coming through from the previous slide about that. First, about that depreciation schedule. Question from Sally. She says, I have an investment property purchased 4 years ago and I don't have a depreciation schedule. If I was to get one now, can the depreciation that I have missed claiming in the last 3 years due to not having a depreciation schedule be claimed, or is it lost forever?
You can go back and do an amendment up to 2 years, but other than that, that's where it'll stop.
Okay, so she's 4 years in, so that's a no.
But it depends upon the property you've got as well. So if a property was built, it's prior to 88, so it's an old property, then the likelihood there's not going to be any depreciation in it anyway. So I'd recommend that what you do is you have a chat with your accountant and figure out what the dates of the properties are and determine whether it's going to be worth your time spending the money to get that quantity surveyor's report.
Right. Yeah, good. And she said also, how does getting a depreciation schedule years after purchase affect the cost base, CGT payable, etc. upon disposal?
Anything that you claim as a depreciation during the time that you've got the property gets added back as a capital gain. So it does actually make a difference on disposal, but because generally the rate of tax that you pay on capital gains is half of what you pay, like you claim back, it's still very advantageous to do it. And you also do it as you're going. So obviously money loses value over time. So if you've been claiming deduction for 20 years and then you've got to pay tax on that amount, we all know that money's worth a lot less now than it was 20 years ago. So it still is very good to do.
Okay. Great. Hopefully that answers that for you, Sally. And also another comment, this is about the income protection. Suzanne says, I had no idea I had income protection or disability through my super account until my accountant took over my financial needs. And that's a shout out to Michael. Yeah.
And that's one of those things that having income protection in super is probably, again, this is a different field altogether. It's a financial planning hat. But when you've got a minimum or a maximum of $25,000 and you're paying $2,000-$3,000 of that $25,000 to an insurance premium, which would have been tax deductible if you had it outside of superannuation, just means that you'd have more money in your superannuation rather than having your premiums chewing it up. But I'm sure that Michael's probably set up things very well for you, so you'd have no problems.
Yes, and in fact, she goes on to say, I had been paying it since I was 17 and could have used it several times after a serious car accident.
Seriously.
But didn't know I had it. Moral of the story, get a great accountant and they will keep you informed. Wow.
That's great. Great feedback.
Yeah. Thank you for sharing. Okay, that's it for the questions at the moment.
Okay, Jim.
Okay. Sorry, where were we up to? I've just lost myself in all that excitement.
It was exciting, wasn't it?
You're about to talk about the huge redundancy payments, which you've sort of touched on anyway.
Yeah, we've touched on it. It's basically a matter of the timing of it. So again, don't take, if you've got the option, and typically I have never seen an employer so far we've been doing this for about 30 odd years now. I've never seen an employer say, no, you're going to take it now, when there's a long-term employee there. They say, well, what's going to suit you? And typically the clients are going to say, well, when should I be taking this? Should I be organising it for now, or should I take it next financial year? And it's always, look, try to defer it where you can, because not only are you going to more than likely be in a lower tax bracket, but also you're deferring any tax liability that may come from that by a further 12 months.
And with redundancies, talking to your accountant is actually really important, because some parts of it are taxable and some parts aren't. Like if it's a bona fide redundancy, there's a certain amount, I think is it 3 weeks per year, Jim, that's not taxable, but things like long service leave and accrued holiday pay is taxable. So there's a lot of other things that come with that as well. So
and everybody's going to have different components. Everybody's payment is going to be made up of different components. So it's not a one size fits all answer. It's simply a matter of have a look at what your personal circumstances are to determine what's going to be taxable within that. And
legislation's changed over the years. So pre-1994 stuff's treated differently to it's a mess, a lot of it, to be honest. So you really do need someone to have a look at it to make sure it's correct as well.
Okay. And look, the moral of the story is plan ahead. Planning ahead. Now, when it comes to personal taxes, we've talked about planning ahead for recognising capital gains. Figure out what your ramifications will be, whether you sign a contract now, whether you sign it later. Figure out that if you're going to have a capital gain, it's a good time to make those additional superannuation contributions in order to minimise your tax. Is it good, if you're going to have that capital gain, to prepay your interest on some investment properties that you may have? Is it going to be good to prepay your income protection insurance? All of these things here are really going to be dependent upon what your personal circumstances are, but it also involves planning ahead to what's going to be happening.
And there could be other things. You could be hanging on to those shares that you've had for years that have lost a lot of money. So if there's a big capital gain coming in that year, if you sell those shares, you create a capital loss, which will offset some of the capital gain. So as Jim said, planning is everything in this area. And also with retirement, with pensions, we won't go into it because again, it's a different topic, but if you've got assets you want to give to the kids, you've got to plan and do that gifting 5 years before you actually want to start claiming pensions, because that can reduce the amount of money that you're able to receive. Again, very complicated scenarios, but you really need to do the planning a long time before you actually want to retire. So, because this stuff all matters in tax too, because doing things properly can either save you tax or get you a lot more money back.
Okay, and now we're going to have a look at some budget changes, hot off the press.
Okay, so one of the first ones that I'd like to talk about, and obviously we're not going to cover everything in the budget, but there was a few things that are actually absolute gems as far as I can see for tax planning opportunities. And this is where now the government's actually introduced where you can actually carry forward or carry back a loss from the current year to a previous year to claim tax that you've paid in the previous year. So this will allow us to go back to the 1919 and 1920 financial years. So if you've paid tax in either of those years and you generated a loss in the current year, you could actually claim that loss in the current year against tax that you paid for the previous year. So hypothetically, we make $100,000 profit last year and we've paid $27,500 tax. Okay. All things being equal, where they're not, because this year's tax rate's 26%, but assume that the tax rate was exactly the same. If we made $100,000 loss in the current year, then that would mean that we could carry back that loss to the previous year and effectively be break even in the previous year, and any tax that we've paid for the 2020 year would be rebated. Okay, so that's a great opportunity. Now, there's a lot of businesses are saying, but I'm in a profit situation. Well, there's nothing to say that tax planning can't be used to generate a loss in order to be able to claim some of the taxes from the previous year. In the past, tax planning has always been, well, why would you make it a loss? A loss you're only going to carry forward. But the fact that you can actually carry back a loss actually makes it a worthwhile exercise to do, providing, of course, you've got the cash flows to support it.
Yeah, because the worst part about that is you used to be able to just carry forward losses, which would save you tax in years ahead, whereas now you can actually get the tax back on it straight away, assuming, of course, you have paid tax in previous years. So it is pretty good. And as Jim touched on, the corporate tax rate has dropped from 20, It's dropped over the years. When we first started doing accounting, it was 39%, was it, Jim?
It's at 27.5 now, and it'll go to 26.
But what I'm saying is it's dropped down from
Yeah.
39% down to 26 over the last 20-something years. So, yeah, it's good. And where this gets some tax planning opportunities for us as well, the more difference between the corporate tax rate and the personal tax rate, then the personal tax deductions become relatively more important than the actual corporate tax deductions.
Yeah.
So sometimes do you do the deduction personally or through the business entity is also something that we look at.
And one other thing as well is the concessional superannuation cap. Now that's gone to 27,500. So now each employee or every individual working can actually have up to $27,500 going into their superannuation, which will either be deductible by form of either salary sacrifice or personal contribution. So at the end of the day, you can get 27,500 going into your superannuation, which is a nice improvement as well.
And the last change, and one that we think is about 20 years overdue, before this budget, the two criteria to receive the superannuation guarantee was that you're over 18 and you earned more than $450 in a month. Well, now they've scrapped finally that $450 threshold. So anyone who's over 18 and earns any money gets money paid towards their super fund.
Now that's quite significant for employers. Yeah. Because you think about now, if you've got a whole heap of casuals that work for you that might be earning $300 a week, $300 a month, $400 a month. Now as an employer, you've got to allow that you're going to be up for another 9.5% in superannuation. Okay, so it will have a significant impact on employers that have a lot of their workforce made up of low income earners that are over the age of 18. So it's something to be mindful of. And that's also going to come into when you're pricing whatever you're doing, you just got to be mindful of, well, that's going to be a cost which wasn't a cost in the past.
Great.
I think that pretty much covers it. There was quite a few other things in the budget which were really, really good, but they've got more of a financial planning spin than a tax spin. But certainly, we're happy to have a chat with our clients and anybody that's on the webinar. If you feel that you need any help in either of those areas, happy to help you out.
Yeah, or anyone who might happen to see the webinar afterwards, because these sessions will be on the ATB YouTube channel and other social media.
One of the things that we've got to be mindful, like we've talked about everything that you can do, okay?
Wow.
It's not actually as easy as it seems to sort of say, well, what am I going to do? How am I going to do it? Where's the cash going to come from? Now, this is tax planning time for us. We're doing it for a lot of our clients. So if there's anybody that feels that, yes, it's easier said than done, but I need somebody to actually help me to figure out what's my forecast profit going to be, what loss do I need to generate, what's going to be the best bang for buck on what I'm going to be spending in order to try to get the most benefit from my tax planning in the current year. We're here to help. It's what we do day in, day out. We live and breathe it. And I'm sure that anybody that wants to work with us in that area is going to certainly see a benefit for it.
Absolutely amazing. Thank you, Jim. And I think this has just been, we're heading into the hour in just a moment or two, but this has been a really, really helpful, I think, checklist of items that has prompted us as the audience to think about, to ask questions and to plan for as we head to the 30th of June next month. And it's just been really, really helpful to stimulate those thoughts and to think about your own unique circumstances. So thank you to the audience members who participated, who are here with us. And I suppose the key thing is talk to your accountant and go through those ideas that you might have bubbling away in your mind after hearing all of this information, so that you can get that excellent advice.
Great. Thank you, Anna. And look, if there's any questions, please feel free to ask you. And if not, I think we can call it a day.
Thank you, Jim. Thank you, Paul. It's been a great session.
Thanks, Anna.
Thank you, Anna, and thank you everybody for taking the time to join us today.